Hello everybody, it's Chuck Carnival, co-founder of FastGraphs, the fundamentals analyzer software tool. And this is actually my second in a row of my standard Tuesday subscriber request series. And it's something I'm really excited about doing. It's a feature that I'm really looking forward to as time goes on here, because what I'm doing here is I'm going to be presenting a video covering common stocks that you all are interested in. And I think that's actually kind of nice, and I think it's real important. So I really kind of like the idea of doing videos on stocks that you're interested in. Now, having said that, I've been a little behind on doing this. Right now, I have over 80 stocks in the subscriber request series. And, really, probably the most difficult job I have at this point is figuring out which of those stocks that I actually should be covering and when I can cover them and in what order. So I had to figure out a way to prioritize that. And I came up with a system here, and I'm going to go ahead and share it with you. I started out by creating a FastGraphs portfolio. And one of the other things that I'm going to be able to do with this series, I think that I'm kind of excited about, is I'm going to be simultaneously introducing those of you who are already subscribers to FastGraphs methodologies and ways that I personally utilize the tool to make my, stock investing process a lot more efficient, a lot more effective, and frankly easier than it is without the tool. And for those of you who aren't subscribers, of course, I'm going to be featuring the tool and hopefully enticing you to at least take a free trial and try it for yourself, because it is a great tool. If you own stocks, I consider it indispensable, but obviously I'm biased. I built the darn thing. So anyway, this is a portfolio that I named YouTube subscriber request. And I want you to notice here there are 82 entities. Now, you can go in and customize these portfolios, and you can pick all these different items. And I'm just staying in the general and current category here, I want you to notice. So what I've done is I've got the name of the company's credit rating, which I think is important, the GIC sector, the sub-industry sector, so that we drill down a little bit on what the actual business is, the price-earnings ratio, if any, that it's trading at, and then the price to cash flow, if any, that it's trading at. And then, of course, the all-important earnings yield, cash flow yield, dividend yield, if they pay one, and then the market cap and the long-term debt to capital. These are just items that I think are important. But what I'm really doing here is I'm going into the GIC sector. That's General Industry Classification Codes. And I'm going to look at these by what you were interested in, what you asked. Now, I want you to notice that out of these 82 entries that you requested that I video about, 3 of them were utilities. We had about a half a dozen here in real estate. There's, 10 or so in information technology. The broad sector industrials, we did, ask for a lot of companies. You can see their names over here: General Electric, L3 Harris, Lockheed Martin. And then as I go down here, healthcare was a very popular sector. You can see that we have quite a few names in the healthcare. And then the one I'm going to cover this week to start out with is financials, which is one of the ones, or the sector, that was probably most commonly asked about. Now, if you look at the sub-industry sector here, you can see there are a lot of different kinds of companies in this financial sector that I'm going to be covering. So, and then, they also had several questions about some energy stocks. And then another popular one was consumer staples, consumer discretionary, and then communication services was also quite popular. So this is going to be fun to do over the next several weeks as we kind of get into these. But today, what I'm going to do is I'm going to look at the financials, okay? And in that cross section here, and I'm going to, I've got 16 companies that are in, the financial sector that I've picked here. You can see them: Aflac, Allstate, and so on. They range from life and health insurance, property and casualty, a lot of asset management companies, property and casualty, what they call multi-sector holdings. I've got a mortgage REIT here, which would be an interesting one to look at, some banks and asset management and life and health insurance, et cetera. So I've got kind of a diverse group of companies here. Now, what I'm going to do is I'm going to go through these in alphabetical order, starting with Aflac, just to make it simple. And I'm going to look at these companies from just the point of view of what I see in the FastGraphs, okay? And again, I'm kind of featuring here how you can use FastGraphs to make your life easier. One of the things I'm always doing with FastGraphs is I'm asking the question, is this stock even worthy of my time and effort that I would have to spend to go ahead and research it further? So if one of the best features about this tool, in my opinion, again, I'm very biased, I built the thing, is that it really helps make my life more efficient as an investor, because I can simply real quickly decide whether I want to spend any time reviewing the stock or not. But I'm also going to be talking as I go through these companies about some of the features that are important about fast graphs and also help you possibly, those of you especially who are subscribers, learn to utilize the tool a little better. I call it a tool to think with. So let's go ahead and start. Let's take a look at the first company, the life and health insurance company, Aflac here. And for those of you who are new to our channel and new to fast graphs, I'll give you a little bit of a quick introductory course, and I'm going to do it by taking the graph apart. I'm going to take some of these components that are on the graph apart here, and I'm going to start by only looking at the company's adjusted operating earnings. Now, Fast Graphs provides owner's earnings, basic earnings, GAAP earnings. We also provide cash flow metrics, EBITDA, EBIT, and even net change in cash. There's a lot of ways to look at a company. We also have things like price to sales, and we've got fund graphs, which stands for financial underlying numbers. So, if I was really serious about that, I really have the ability here to go really dig deep into the company. But what I start out with is we use formulas that draw what I call valuation reference lines. Now, one of the best features about fast graphs are that they're theories. Now, these valuation reference lines are drawn using formulas that are essentially discounted cash flow based formulas with what I like to say with a slight twist. We have our own version of the discount rate that we utilize, which really turns out to be the company's earnings growth rates, past, present, and future. But having said that, what we do is we apply these formulas, and the system, the tool, automatically creates a valuation reference line. Now, for many, many stocks, you're going to very commonly see that it turns out to be a PE ratio of 15, which is a common valuation for common stocks, the common valuation for the stock market in general, and for a lot of stocks. Not all stocks, but a lot of stocks. It'll be one of the most common PEs. Legendary investor Ben Graham said he never wanted to pay more than a PE of 15. And it also represents an earnings yield of 6.67%. Earnings yield is simply, instead of the price divided by earnings, it's the earnings divided by price. But this gives me a valuation reference line. Now, what this does is gives me the opportunity to backtest the theory, to backtest the formula, if you will. So when I add monthly closing stock prices on the graph, what I'm looking for is this theory hold water in the real world? In other words, does this apply? Now, the first thing I see here as I look at this graph, these are monthly closing stock prices. There was a period between these last two recessions where the stock, if I run my mouse along here, you can see at the very bottom of the pop-up, the PEs, ranged from 19 to 20, in that era. So there was a higher valuation applied to this stock. The orange line is a 15 PE, remember. And then as we came into the Great Recession, which, by the way, was financially instigated in the minds of a lot of people, it was the loose money, the collateralized debt obligations, we can go on about that. And we all were aware of that. That created this huge collapse. Now, I want you to notice a couple of things interesting while I talk about that on this particular company. Now, this company has a lot of business in Japan and so on. But anyway, bottom line is this business continued to do really well through this recession. Look at the earnings growth rates, 15%, 21, 22, 14. And yet, in spite of that, the market value of the stock collapsed, as did almost every stock in the market at that time. And then since that time, I want you to notice that valuations have been lower than historical norms. Prior to the recession, we had these high values. Now, since then, we've seen values in the 8, 9, 10, even as low as 6 times earnings range. So the next valuation reference line that I can utilize kind of to backtest the theories is to add just the market value, the normal market PE ratio. And that's this blue line on the graph. Now, when I'm looking at this, I get a number. Right? So you can see that the blue line now is a PE of 13 and the orange line is a PE of 15. I'm just going to use round language here. In other words, it's 13.29. We'll call it 13. All right, so that anywhere I point to this, the PE would be 13. When the price is below that, it's below that. But watch what happens when I shorten the graph. Okay, when I shorten the graph, what happens is I find out now that my normal PE post the Great Recession, and I can go back a couple of years to kind of illustrate that more clearly. Once the recession came and reset the valuation, then we all of a sudden start getting a 10-ish. And I never look at these numbers as absolute precise numbers. I look at them as a range. So, that blue line is about 10 times earnings. Now, that has been the very high correlated historical valuation multiple that the market has been applying to Aflac. So anytime I could buy Aflac when the price is below that 10 multiple, that blue line, that would make sense to me looking at it from historical precedents, at least over the last 15 years or so, that's a pretty good valuation. Now I've got a blended PE ratio of 9.89, just slightly under the 10. So the valuation here looks very attractive. It's undervalued. I even have a slight margin of safety. Now, a few months ago, back in even October of 2020 and such, which was obviously the year we all want to forget, this is the COVID crash. And once again, this company did actually pretty well, despite everything that was going on worldwide with COVID. But having said that, the company's stock price has rallied very strongly. Now, this company pays a dividend of almost 3%. Current dividend yield is 2.71%. So let's go ahead and add the dividends with the payout ratio. Dividends, POR here, stands for dividends payout ratio. So this white line now gives you dividend information. Okay, we have the actual amount of the dividend on that year, the dividend yield that the stock was offering at that time, the earnings per share, and then the payout ratio. In other words, the 24% payout, everything below this white line is the portion of earnings that the company's paid out in dividends. So you can see that this company historically has averaged a payout ratio in the 20% range. I can double check that and see it in a little more detail by going to the performance report, and I can see that the payout ratio is consistently in that 20, on the low side to 25% on the more normal side of the company. That's a very low payout ratio, and that's kind of attractive. Company's A- rated, which is another plus in my opinion. It only has 18% debt. So the reality of it is, as I look at this stock, I can see that a 10 multiple has been a very consistent, I would say predictable and reliable valuation reference. So I'm going to also now put dividends on top because I want you to understand something else. Your capital appreciation is going to be a function of the price going from point A, and I've set it up here where the valuation here was pretty close to fair value. It was an 11 PE back here in the beginning, and now we're trading at about a 9.9 PE, and I've got a growth rate of about 7%. So I'm going to get a total annualized rate of return that's going to be pretty close to that. Now, the reality of it is, if I go to my performance report, my capital appreciation was actually 6.4%. That's the company's historical growth rate of 7% with a little bit of PE retraction. I went from an 11.5 PE to a 9.9 PE, if you will. So that basically explains why instead of 7% growth, I only got 6.4% growth. But I turned $10,000 into $21,256, but I also received $4,190 in dividends. That's why I stack dividends on top here, because I want you to basically have the perspective that the capital appreciation comes from what happens to the price from point A to point B. But in addition to that, if the company pays a dividend, you also get this dividend income. And this light green shaded area is essentially what you see below this white line. It just gives you the different perspective of the dividend. So that's how the fast graphs works. Now, I'm going to look at what could I expect to make on this company by looking at it. So I go to my forecasting calculator and, I look at consensus estimates looking for only 1% growth this year, but then followed by 5 and 6%. So I've got an average of about 3.81% expected growth going forward. Now, if I was using the 15 multiple, that would give me, if the stock reverted to that mean valuation, about a 22%, rate of return over the next, call it 2 3/4 years or so, over the next 2 years, a 31% annualized rate of return, capital appreciation of 59.6%, if you will. And I can go ahead and mark that. That's your 59.6. And if I went to just the next year, the next 8 or 9, 12 months or so, I could see the stock go up 50%. But that's being aggressive with a valuation that we haven't seen in the last decade. So in this case, I'm going to rely on the normal PE, that 10-ish PE ratio. Now I've got a drop-down window here that I can use that allows me to review what PE ratios have historically been. And you can see that a 10 or 11 multiple on this stock really nails it. That's really a very good valuation reference, if you will, to consider buying Aflac. So, simple logic says if I can buy it below that 10 multiple, in this case I'm looking at 10.74, I probably got a pretty good buy. By the way, I could make this closer to the 10. This is about as close as I think I can get here, 10.1, and I can use that as maybe a more conservative case. So this is a calculator. Our forecasting tool is a calculator, and it allows me to do these various calculations. So here I can now say, okay, I've got about a 6%, rate of return potential at, maybe 7% going out for the next 3 years if this stock stays at this 10-ish multiple. If we do get a reversion to, more realistic or more normal historical norms prior to the recession, which is always a possibility, but we haven't seen it in more than a decade. So bottom line is I'm looking at the normal multiple on this company, and I'm saying I've got about a 6 or 7 or 8% annualized rate of return, including dividends. But I also have a company that has a very excellent record of increasing their dividend every year at double-digit rates. So if I was looking for income and wanted a 7% rate of return, I would consider this, and I'll shorten the time frame so we see it currently. I would consider this an attractive valuation with a small margin of safety, but with a rate of return potential that would be decent, 7 or 8% going forward, but not necessarily a great investment. So that's a lot of looks at Aflac. So let me move on to the next company on the list here, and let's look at Allstate. Now, Allstate is a property and casualty insurer. First thing that I see when I look at this stock is I see a lot more cyclicality. I got my same valuation reference lines. Once again, I see another case of the financials trading at a discounted valuation. And what I'm doing, ladies and gentlemen, is I'm analyzing this. I'm looking at this and I'm learning from the past. I'm using a back-tested mentality here. How has the market actually treated this stock historically? That's a very important, I think, for me to know. Now, I'll shorten the time frame again to kind of get, just coming out of the Great Recession. Now, again, I see a stock that trades at around an 11 multiple, 11.37, is what the multiple has historically been here. So, I'm looking at a company that I want to pay about 11 multiple. It's currently only trading at a 7.6 multiple. It is expected to have a down year of earnings this year. The company does have a very low dividend payout ratio of 14 or 15%, pays almost 3% yield at the current valuation, and looks very, very attractive with a nice margin of safety. Now, when I go to forecasting, once again, in this case, and I probably do this with most of these financials here, I'm going to ignore the orange line, the 15 PE ratio, and focus more on the normal PE that the market has been historically applying. But I get some very attractive rates of return by looking at Allstate. The only thing I don't like about Allstate is the fact that the company has a lot of cyclicality that makes it a little challenging sometimes to analyze, but yet it has a very good track record at the same time. It has a very good long-term dividend streak. They have frozen their dividend in 2010. That's coming out of the Great Recession. Otherwise, they've grown the dividend at an average growth of 4.5, a compound average of 2.5. So, not spectacular, but certainly not bad. It produced about the same amount of income as the S&P. It gave a close, approximation of the returns you got in the S&P, underperformed it just slightly. And again, a lot of that has to do with the fact that the company's earnings growth rate. Let me refresh this graph. I got a pop-up stuck here. The earnings growth rate of this company has been, relatively modest over its history. And so, that's what I would really be expecting. Anyway, I think you get the point. I'm done with that. This is important in another feature coming up here. So let's move on. Let's go on to Ameriprise. I got myself a little discombobulated there. I apologize. Let's look at Ameriprise Financial. Now, this is a slightly different story. First of all, I want you to notice that this stock has a much better growth profile, about almost 11% a year historically. A little bit of cyclicality. Again, we see an example of a company that trades at around a 12 or 13 PE ratio, but we also see an example here of a company that also trades at a 15 PE ratio. So when I'm looking at this company, it's not a stretch to say that I would judge a fair value reference here as a 15 PE, which is currently almost exactly what the stock is trading at, as you can see here. Now, it's got an earnings yield of 6.5%, which is in my wheelhouse. I like 6.6, but 6.5 is okay. A dividend yield of 1.82%. It's got a low dividend payout ratio of about 24-25%, as you can see. Historically, though, if you're patient at the same time, I can learn by looking at this graph that I can buy this stock at very cheap multiples quite often, and those multiples usually revert back to that 15. So I could actually use either one of these references as potential, returns with some logic or common sense. And now I've got some really great numbers. We're looking at estimated earnings growth of over 17%. We're looking at 13 analysts that are forecasting that. 6 months ago, for this fiscal year, the analysts were forecasting $18 a share in earnings. They've increased that to 19.5, so the analysts are getting more optimistic. I see that also with the 2022 data, and I don't really have any data for 2023, and I don't like to go out much further anyway, but this would generate a very high 31, almost 32% annualized rate of return if it moves to that 15 multiple. On the other hand, if it stays around the 12-ish multiple, which, the blue line is in that 12 multiple category, now I'm looking at a stock that would generate about a 9 or 10% rate of return going out for the next 2 years. And there would be a possibility that I could see a rather weak return this year, maybe 5 or 6%. 5.91 would be what it calculates, assuming all these numbers were correct. And looking at it historically, the bottom line is I would say this stock is buyable today. I would call it fully valued, certainly not overvalued. But on the other hand, by just looking at my fast graph here, I would say if I'm patient, odds have been pretty high, at least over the last 20 years or so, that I could buy this stock at a lower valuation. And by doing that, enhance my rate of return. Let me illustrate that for you. If I bought it here on the blue line, okay, and held it till today, and that would be on November 30th, 2015, I would have made 16% per year annum. That's very, very attractive, okay? And that was buying it in November of 2015. If I'd have waited, however, till February, like 3 months later, and bought the same stock at a valuation of a PE of only 9, that pushed my rate of return to almost over 24%. Significant difference here. And so valuation does matter. And my point is, you can buy this stock here. If I bought it on the orange line here, and held it to here. I just want to give you some ideas also how to use the tool. I still make 11% a year. But once again, if I waited a year or so and bought the stock when it was trading just on the blue line, my rate of return goes up to 16%. That's significantly different. 10,000 grows to 20,000 in this case, and actually a shorter time frame than if I took this time frame and grew 10,000 with a longer time frame into only 17,000, averaging an 11% rate of return. So I had to wait longer to get less money simply because I wasn't as disciplined with valuation as I should be. This is an excellent company. By the way, for disclosure, I'm long this company, but fortunately I bought it when it had a margin of safety at much lower valuations. Now, I have no intention of selling the stock at these prices because I do consider this, as you see here, a good long-term hold, and the company is forecast to grow at 7 or 8% or higher going forward. So, I like Ameriprise very much, but I do think the stock is fully valued today. So moving on, let's go to Brookfield Asset Management. Now, as you can see, this company is very, very cyclical. This is an asset manager that actually does kind of some interesting work. So I'm going to show you another feature of Fast Graphs here. I'm going to go up to the internal links and I'm going to click right directly onto the company's corporate website. That allows me to go in and learn a little bit about what it is. Now, they call themselves an alternative asset manager. They have $600 billion in assets under management and 120-year heritage as owners and operators. They also like to invest their own money alongside many of their businesses, and they invest in real estate, infrastructure, renewable power, private equity, and they also own Oaktree, which is a very credible private asset manager that, the registered investment advisor that has done, has a really good long-term tracker. So this is a very interesting company. It's a bit cyclical. Earnings growth, though, comes out at 12%. And when I look at it from a performance point of view, the company has dramatically outperformed the S&P 500, averaging double-digit rates. And remember, this is a period of time, though, when the S&P would have been overvalued back here. But a lot of it had to do with the stock was undervalued. It generated good growth, albeit not real consistent. We did have a dividend cut, by the way, coming out of the Great Recession. You can see that by looking at the dip in the white line here. But since the Great Recession, if we look at the last several years, the dividend, let me knock one more off, from where they cut their dividend, now they've grown the dividend at about 7% a year since. So it's, for the last decade or so, it's been very consistent, has a very low dividend payout ratio. It's A- rated, but does have 80% debt. From a standpoint of attractiveness, I would say this company is fairly valued. Looking at the normal multiple, which has actually been a lot higher in this example in the last couple of years. But again, I want to review that. I want to look at what historical normal multiples are. And I think a more fair multiple is the 15 PE ratio. No sense doing it there. I can just look at it right here. So I would feel very good that this company could give me a decent positive rate of return going out over the next 2 or 3 years if I was buying it at a 15, if I bought it at, this is a 13.39 PE here. If it went to a 15 multiple, that would be this line right here, approximately. It's 15.17. I can make 16% rates of return. So I'm just playing the odds. I'm trying to come up with a rational thesis of what I think I could make buying this stock. I could calculate it here as well, and I get that 11% a year over the next couple of years, and that's the stock going to a PE ratio of 15, because now I'm using the P equals growth rate formula. I know I'm throwing a lot of stuff and I'm covering it very quickly, but I also want you to get a feel for how you can utilize this tool. Anyway, that's Brookfield Asset Management. The next company I'm going to look at now, the thing is Franklin. Now here, you learn a lot of things about the stock by just looking at the fast graph that are important. The company was a tremendous grower back, even between the two recessions, got hit pretty hard during the Great Recession. Then it rallied very strongly, but if I go back since 2014, there's been a lot of earnings stress in this company, possibly ETFs and things like that have hurt them, because if you're not familiar with Franklin, this is a very large mutual fund company. Again, it's another asset management and custody banks. It is expected to turn themselves around. Forecasts going forward are a little more positive than they've been. There are 14 analysts. They were forecasting $260 a share for 2021, which, by the way, ends in September. They're now forecasting $304, so they're getting more positive on the stock. There is a high margin of safety, so the rate of return potential for this company, based on its extremely low valuation, could be extraordinary over the next couple of years. But I would call this more speculative, but yet, that means a little more risk, but there's also a much greater reward for taking that risk. So if you're looking to make money, it is an A-rated company with only 35% debt. It's got a great long-term, track record and history. It's got a really strong dividend record. I would check that, averaging 14% growth in income. If I buy it at today's low valuation, I've got a dividend yield of over 4%. So this is something that has merit, but you do have to take into consideration that it's been a very, very lousy investment for the last 4 or 5 years. So in order to buy this stock and take advantage of this, it's lost 8% annualized. It would turn 10,000 into almost, in the 5,700. That's a 53% drop since June of 2014. So you're looking at a stock that's been a horrible performer. But again, you can't buy the past anyway. You can only invest in the future. The future looks a lot brighter. So here's one you might want to do some research on. If you believe that it's going to be brighter, you certainly have a margin of safety that gives you an opportunity to take the risk that you've seen here. And if these analysts are correct, then you've got a possible potential great winner here on Franklin. Blackrock is one of the most largest, solid, AA rated, low debt, quality money managers on the planet. Again, another asset management and custodian, one of the biggest in the world, run by a bunch of really smart people. You can see that the stock price has tracked earnings. The growth rate has been 16.5%, over the last 20 years. If I look at it from a standpoint of the last 11 years, the growth is still double-digit 11%. Here we see a case where the market likes to put a premium valuation, but I want to make another point here. By looking at this chart, I also basically get the idea that, if I'm patient, if I really want to own this stock, it might make sense for me to buy it when I could get it at a lower valuation, and there's a possibility that could happen. Because looking at it from a standpoint of forecasting right now, if this reverts to the mean, I could actually lose money over the next couple of years. That's a risk. If I apply the normal PE, I could have a decent 6 or 7% rate of return. But because of the valuation, my way of thinking, I'm taking a very high risk, a high valuation risk. My earnings yield's only 4.7%. To invest in this company today, when if I'm patient, I might be able to buy this at a much lower valuation. If I buy it at a low, or what I'll call an attractive valuation, like a 15 PE, and I get this high, I can make 19 or 20%, per year. I buy it at a high valuation, like right here. And even though I still make money, I still make 10%, but I've taken a lot more risk to get a much lower rate of return. And that's the real message I want to give there. But Blackrock is a superb company. I consider it overvalued today moderately, and I would wait patiently. Chubb is a very cyclical company, a very good dividend record. I do believe the stock is not a real bargain today. I think it's trading at a premium valuation. These orange lines, by the way, ladies and gentlemen, this is my valuation quarter. This is full value. This is mid-range value. This is low value. And of course, down here, we'd be getting into undervalued. I would call this fully valued to slightly overvalued. The PE over 20. Earnings yield of less than 5%. It is an A-rated company. There is no meaningful figure for the debt here because debt kind of is their product. It's a property and casualty insurer. It doesn't mean you would lose money owning it here, but I think, for the cyclicality and everything else for the company, the relatively low yield, 1.86 relative to other financials, and the high valuation relative to other financials, I would personally look elsewhere. And what this fast graphs is helping me do is saying, I like Chubb. I would be interested in Chubb. If I could buy it with this real, low valuations and high margin of safety, I would, but I'm not so interested in it today. Cannae Holding, I don't know anything about this company. This was one that someone asked me about. If I go into the company's website, it's led by William Foley, who I don't really know who he is. He's had some, pretty decent track record working for some decent companies. I'm not even really that much impressed with, I don't want to really denigrate the company. I'm not really that impressed with their website. I just don't see a whole lot to interest me here. I don't really have any fundamental data. I've got losses expected over the next couple of years. So, I don't really have much of a track record either, by the way. The rate of return has been very, very high. But if I shorten the time frame, that number changes. It's even higher. And over the last 3 years, it's all of a sudden negative 44%. So this is a company that I don't have a lot of data on. I just wouldn't be too interested. I'd maybe give it a couple more years or look for other places. Now, I showed you Eaton Vance. I didn't show you Eaton Vance. I showed you Morgan Stanley because this company I was asked to look at, it no longer exists. In other words, you won't be able to draw this graph very much longer. If you notice, I'm here at February 26th on the last price. You can see in the news here, Morgan Stanley bought them. The stock was very undervalued, as you can see here, when Morgan Stanley made their bid. And then, of course, it rallied, up to these high values here after Morgan Stanley made that bid. But again, you can't buy Eaton Vance today. If you were interested in Eaton Vance, you would be buying Morgan Stanley, which Eaton Vance is now a part of. And that's another financial that you didn't ask about other than through, asking me about Eaton Vance. So let's go ahead and look at Morgan Stanley. Morgan Stanley would be, I would say, fully valued with a risk of some down earnings now. Pretty cyclical company historically. It's got a decent dividend record for the last 7 or 8 years. But again, I would pass and look elsewhere. Moving on, let's go ahead and look at Invesco Mortgage. I told you the mortgage REITs were going to be interesting. A lot of people like these. I personally don't. Okay, the dividend yield is 8%. That's going to attract people. There's no real PE because they lost money in 2020. They are expected to see a nice, pop in earnings back to 30 cents, 112%. Calculated growth rate, but it's still not very well. But if I look at the long-term performance of this company, a $10,000 investment made essentially when it went public in June of 2009 would have thrown off $12,849 in dividends versus only $4,500 in the S&P. But that $10,000 investment would have shrunk to only $2,000. In other words, you'd have lost almost 80% of your capital, an annualized loss of 12%. you end up eking out a positive rate of return, but all of it thanks to the dividend. And yet when I look at this, the dividend has been slashed greatly and is expected to be relatively low, even though the yield is 8%. These are not my cup of tea. I'm not really too crazy on mortgage REITs for the reasons I've just shown you here. The next company here is a Bank of Ozarks, and this is interesting because if you're going to buy any of these small regional banks, they should have been bought 6 months or a year ago. Now, they did suffer with COVID. You can see how the price correlated to a 15 multiple very closely. You can see periods of overvaluation, reversions to the mean. The stock got very inexpensive, and this was, kind of a Warren Buffett, be greedy when others are fearful and fearful when others are greedy. Everybody was fearful here. And, the stock wasn't very popular. But now, as COVID is kind of going away, you can see that the stock has rallied very strongly just, it's almost doubled just since March of 2020. So in just a little less than a year, it's gone up 151%. Adding in dividends, you've got 180% rate of return on this stock. But today, it's trading essentially at what I would call a mid-range valuation. It does still offer great returns if it moves back to this 15-ish PE ratio, but it's not expected to grow very much over in 2022 or 2023. So, but again, it's a stock that you should have looked at maybe 6 months ago. People's United, it's another regional bank. We have almost the same story here. Little different record. There has been a time, this blue line becomes meaningless, by the way, on this graph until you change the time frame and get rid of some of those anomalous numbers. The market has had a penchant, even since the recession, of applying about a 17 multiple. The company's BBB plus rated with 15% debt. I can go in here to the company's website and learn a little bit about the stock, as I mentioned to you earlier. But it's a pretty good run, little well-run bank. I guess it's New York based. The valuation now it's become fairly valued. The word fairly valued can also be fully valued. There's no bargain here. There's no longer a margin of safety. But it does offer almost a 4% dividend yield. So I wouldn't say it's a horrible investment here. But this might be another one of those cases where the opportunity's been lost. It should have been woulda, coulda, shoulda, of course, should have been bought, back in the fall of last year and you'd have a nice rate of return, on it sitting there right now this year. My next company is Digitech. I know very, very little about this company. It's a consumer finance company. It's had tremendous growth. It doesn't have much of a track record, as you can see, but these growths are anomalous. You certainly don't want to look. I'm looking at a PE ratio of 15 here, but I've got earnings growth that's staggeringly high. If I look at forecasting, it's expected to grow at 20% a year. I would call this a very interesting speculation. It's one that you might want to, speculate in, but I don't know a lot about this stock. Again, you'd want to, but it is one that looks interesting enough. It's a Chinese-based company in consumer finance, so it's something that could be of interest for those of you who are interested in investing in international stocks. But, the growth is there, or at least it's expected to be there. T. Rowe Price, another excellent manager. I put it in the category of one of the highest quality asset managers in the country. Stock is, I'll call it fully valued to just, fully valued is the right word, I guess. It's trading within this range of corridor, but it's no bargain here, but it would offer a decent rate of return. Offers about a 2.56 or 7% dividend yield. The company's earnings yield is about 6%. It has 1% debt, no credit rating. It's got a really good track record. If I look at it historically, it has outperformed the market dramatically, produced a lot more dividend income. But again, I would have been wanting to buy this stock when I would have had a built-in margin of safety. But the market has put premium valuation on this stock many times. So when you're looking at forecasting, if you were willing to take the risk, you could look at that normal multiple. And by the way, the normal multiple would be closer to a 16 multiple. I'm just picking a number here. And you would start to get double-digit rates of return. It's a quality enough company that you might be willing to take that risk. But clearly what I'm seeing here is the stock is not a bargain at today's valuations. Now, the next would be Unum. I would consider this a very high-quality insurance company. 23% debt, life and health insurance, trading at an extremely low value. It's starting to recover, offers a 4% yield. If I look at the company, just before the Great Recession, performance-wise, they did freeze their dividend for several years, 05, 06, 07, but they've grown it on average about 6 or 7% a year. It's got a 4% yield. Even if I look at it from the standpoint of its normal multiple being about 8, just giving it a very, very low, what I'd call normal multiple, there would be an awful lot of money to be made in this stock. So this is one with only 20% debt that I think would be worth taking a harder look at. You want to know why the stock is down, and what, confidence you might have and why the stock might be, a better thing going forward. The analysts have lowered the estimates. That's slightly different than what we saw with several other examples. 6 months ago, they were forecasting $5.35. They've dropped that to $4.72, but even $4.72 at an 8 multiple would be 49%. The company has an incredible earnings yield of 18%, a dividend yield of 4%, and you can buy it at a PE for 5.5. So this was one that I think would make a lot of sense to look at. By the way, I'm long this stock for those reasons. And then last but not least, Wells Fargo. Wells Fargo's had several controversies over the last couple of years. I don't follow this stock anymore. They slashed their dividend. They slashed their dividend before. It is expected to rally quite a bit from an operating point of view. Earnings growth is expected to be very strong. So if you're willing to take those risks and willing to look at this company from the standpoint of a recovery, it might be one that would be of interest to you. But this is one that I would personally pass on because I just really don't like the fact that they've slashed their dividend. They had, some customer issue complaints in the past, but a lot of people like Wells Fargo, and when I look at it here, I don't like the dividend record, I don't like the earnings slice. So anyway, this has been Chuck Carnival taking a look at the financial sector for you. There were 16 companies in here across these various subsectors. A lot of value in the financial sector. There's a lot of opportunities to look deeper. I hope you enjoyed this video. I've certainly enjoyed giving it. I apologize for the length, but we did cover a lot of stocks here. I hope you enjoyed it. I hope you got something out of it. If you did, please give me a like. I always appreciate that. Who doesn't like to be liked? Give me a share. If you think if you have no friends or family that would value from this, go ahead and share it with them, let them see it. And then also, if you're not a subscriber, please subscribe to the channel. We got a lot more of these coming in the future. This has been Chuck Carnival. Thanks for watching. For our next subscriber request series, I'll see you next Tuesday. But in the meantime, I'll be doing some other videos later on this week, tomorrow and the day after, etc. Thanks for watching. Talk to you soon.